It's a pleasure to be here to talk about payments. The confidence that payments will be timely and dependable is a cornerstone of America's dynamic and resilient economy. Most Americans take the reliability and the safety of our payment system for granted, but that wasn't always the case. The nation's first 150 years were frequently disrupted by panics in the financial system that extended into the payment system, which was highly fragmented and inefficient. Before the Federal Reserve took on a role in the payment system, a check recipient could not count on receiving the full value written on that check and faced long and unpredictable delays in getting access to those funds. As a result of banks' efforts to avoid excess clearance fees, it could take days, weeks, or even more to clear those checks. The second chairman of the Federal Reserve described the circuitous, opaque, and costly route a typical check might make. And this is in his words. A bank in Rochester, New York, sent a check drawn on a Birmingham, Alabama account to a correspondent bank in New York, which sent it along to a bank in Jacksonville, Florida. From there, it traveled to Philadelphia, Baltimore, and Cincinnati before it finally reached the originating bank in Birmingham. The fragmentation of the payment system imposed huge costs on American merchants, households, community banks, and ultimately on the overall economy. Ensuring a reliable and widely accessible nationwide payment infrastructure was in fact one of the motivations that led Congress to create the Federal Reserve after the very severe financial panic of 1907. And following our creation in 1913, the Fed's responsibility for a new core infrastructure for clearing and settling checks led to increased confidence in banks and in the payment system, ensured Americans would receive the full value of their checks, and greatly reduced the amount of time for payments. That was the first, but not the last time, that we played a central role, along with the private sector, in transforming America's retail payment system. By the 1970s, the payment system was staggering under the weight of paper checks. A governor of the Federal Reserve Board described the exponential growth in check volume and the time-consuming and expensive process to clear paper checks as a time bomb. The Federal Reserve and payment system stakeholders faced a choice: continue making incremental changes to manage that growing avalanche of checks, or look to technology to facilitate transformational change. And all of the people in this room know what choice was made. Working with the private sector, the Federal Reserve chose transformation, and the effect was dramatic. The Federal Reserve supported the implementation of the Automated Clearinghouse, or ACH system, to process payroll payments, bill payments for households, and vendor payments for businesses. Before the advent of ACH, it would typically take a week for an employee to be able to access the funds from a paycheck, requiring first a trip to the bank during business hours to deposit the paycheck, and then several business days for that bank to complete the time-consuming process of collecting the funds from the employer's bank. With the advent of ACH, an employee could access their pay from the bank on the same day. It was deposited electronically by their employer. Today, ACH operates with important roles for both the private sector and the Federal Reserve. It's available nationwide, and it constitutes a vital piece of the infrastructure supporting earlier access to funds and reliable settlement of payments. Today, our payment system is again at a crossroads. There's a growing gap between the transaction capabilities we need and expect in the digital economy, fast, convenient, and accessible to all, and the underlying settlement capabilities. Consumers and businesses increasingly expect to complete transactions with a simple keystroke, a swipe, or a tap. If I want to split a restaurant tab with my friends, I can use an app on my smartphone, but my friends have to be signed up for the same app to receive the payment, and they may have to wait for confirmation that the funds have moved from the app into their bank account before they can use the funds outside that app. Similarly, if I want to make a purchase from a vendor online, all I have to do is upload my payment information and touch a screen to complete the purchase immediately, but that payment in turn may not be immediately available to the seller. While we're seeing a growing demand for payments to be as instantaneous as the apps on our smartphones, in reality, under the hood, these payments currently rely on a patchwork of systems that can result in inefficiencies and delays, as well as uneven access. To meet the expectations of our 24/7 app economy, there's a growing demand for broadly accessible payments that make funds available immediately. Faster payments would allow consumers and businesses to send and immediately receive payments any time of the day, any day of the year, and to use their funds anywhere they choose. Nascent faster payment services are emerging to address this demand from individuals and businesses, but gaps in the underlying infrastructure pose challenges associated with safety, efficiency, and accessibility. In many circumstances, the underlying infrastructure in place today cannot ensure that a fast payment is fully complete before the recipient seeks to use the funds. To complete a payment, the banks behind the transaction need to transfer funds between each other. Until this happens, the payment between them is more like an IOU. That's because the systems that transfer funds between banks are not set up to work in a 24/7 world. Instead, most faster payments settle funds between banks on a deferred basis. Deferred settlement entails a buildup of obligations, like IOUs between banks, that could present real risks to the financial system at moments of stress. Although faster payment systems that rely on deferred settlement can incorporate measures to mitigate these risks, these measures may be appropriate for a nascent faster payment market only for a limited time. As we saw with the growing avalanche of paper checks prior to ACH, as the volume and value of faster payments grow over time, the potential risks of deferred settlement to the financial system are also likely to grow. To fully deliver on the promise of faster payments into the future, we need an infrastructure that can support continued growth and innovation with a goal of settlement on a 24/7 real-time basis. To ensure the robustness of the payment system into the future, banks and other providers acting as their agents should have access to a settlement system that operates 24/7 and settles each payment as soon as an individual sends it. While everyone stands to benefit from faster payments, the benefits could be especially important for households and small business owners who face cash constraints. We know from the Fed's survey of household economics and decision-making that 4 in 10 adults say they would need to cover an unexpected expense of $400 by borrowing or selling something, or simply be unable to pay. Similarly, by some estimates, a quarter of households have less than $400 combined in their bank accounts. For these households, the difference between waiting for a payment to clear and receiving a payment in real time is not merely an inconvenience. It could tip the balance toward overdraft fees, bounce checks, or collection fees. Of course, faster payments wouldn't address the root causes of financial fragility, but it could help reduce the strain on some. Similarly, many small businesses cite immediate access to working capital to finance inventories or pay employees as their #1 constraint on growth. Smaller businesses and merchants would benefit from faster payments because of their need to tightly manage how much of their capital is tied up in unused material or inventory. If a small business owner could count on their customers' payments being immediately accessible, it could reduce the need for short-term financing to cover the costs of ordering materials and goods in advance. So what is the Fed's role at this moment of opportunity for the payment system? 5 years ago, as Dave Saponaro described, we launched a collaborative effort with a broad array of stakeholders to catalyze a safe, efficient, and accessible faster payment system for the United States. As part of that effort, 300 organizations representing consumers, businesses, banks, card companies, and technology providers, including many represented here today, came together to define your expectations for the future of the retail payment system and to make recommendations on how to implement those expectations. The members of the task force told us that the Federal Reserve needed to develop a 24/7 by 365 settlement system. The U.S. Treasury recently echoed this theme in their report. Over the past year, we've undertaken an assessment of what the Federal Reserve could do to modernize our infrastructure to support interbank settlement of faster payments. That assessment found that 24/7 payment-by-payment interbank settlement in real time, what we refer to as real-time gross settlement, could offer clear benefits in minimizing risk and maximizing efficiency. A 24/7 economy with 24/7 real-time payments needs 24/7 real-time settlement, and RTGS is the way to achieve this. That's where we believe the Federal Reserve and the private sector together need to make investments for the future. In this regard, the U.S. retail payment system lags behind some other countries. The Reserve Bank of Australia and the European Central Bank have already implemented or are on the cusp of implementing RTGS systems to support private sector faster payment services, and we are studying their experiences closely. The Federal Reserve and payment system stakeholders have an opportunity to upgrade our payment system to meet the needs of households, businesses, and banks in the app economy. That's why today we're publishing a Federal Register notice that seeks public comment on potential steps the Federal Reserve could take to support the vision of RTGS for faster payments. The reserve banks could develop a service for RTGS that is available on a 24/7 basis to provide payment-by-payment interbank settlement in real time at any time, on any day, including weekends and holidays. The reserve banks currently provide payment services to more than 11,000 banks across our country. A 24/7 RTGS service provided by the reserve banks could significantly improve the prospect that banks of all sizes will have equitable access to a real-time interbank settlement infrastructure for faster payments in the long term. This common infrastructure would support connections across banks and faster payment service providers acting as their agents, with the potential to weave together the current patchwork of systems. As a result, we'd also expect the overall safety of faster payments to increase. The capability to finalize interbank settlement before funds are made available to the recipient would avoid an undesirable buildup of risk in the system. The more banks that have access to real-time as opposed to deferred settlement mechanisms, the lower would be the risk from deferring settlement to the payment system as a whole. Although RTGS may be operationally demanding, it offers clear benefits from a risk and efficiency perspective over the long term as faster payments scale up. The development of a nationwide real-time interbank settlement infrastructure could support the development of private sector faster payment services, thereby increasing innovation and choice in the market. Banks and technology providers of all sizes may be able to develop new services or enhance existing services by capitalizing on the underlying interbank settlement infrastructure. This could ultimately benefit all consumers by lowering costs, increasing choice, and improving quality. In that regard, we're also seeking comment on whether the Reserve Bank should consider developing a liquidity management tool that would operate 24/7 in support of services for real-time interbank settlement of faster payments. The tool could support settlement services provided by the private sector or the reserve banks. The Federal Reserve has a responsibility to promote a payment system that serves the evolving needs of the public. We hope to solicit a range of views as we consider these and possibly other options to support prompt, secure, and resilient settlement in a 24/7 world. To that end, the Federal Register notice poses a series of questions related to whether an RTGS is the appropriate strategic foundation for interbank settlement of faster payments. We also solicit views on the appropriate role for the Federal Reserve in such a system. We look forward to hearing from and learning from a broad array of stakeholders. The future of payments will be determined by the actions we take today. We can wait and watch how these issues evolve on their own. If we do, it will likely result in a fragmented patchwork of systems that entails inefficiencies and risks and could leave behind many households, small businesses, and smaller banks. Alternatively, We can work with other stakeholders to embrace innovation and design a faster payments infrastructure for the future to promote broad access and resilience. As technology continues to drive payment innovations, we continue to focus on the same basic objective that motivated our initial engagement in the payment system a century ago, promoting a safe, efficient, and accessible payment system that serves the interests of all Americans. The Fed has the unique ability to provide the infrastructure to reliably settle obligations between banks using balances at the central bank. As such, we believe we have a responsibility to serve the broad public interest by providing a flexible and robust payments infrastructure on which the private sector can innovate. We are looking forward to hearing from you on the important choices before us as we all work together to safeguard the integrity and the efficiency of our payment system.